So now we're going to work through problem P832A, which is on page 466 of your book. And it's basically just a bunch of transactions that are related to accounts and notes receivable. So let's start with this first one. So we have on December 6th, we received a $9,000 90-day 12% note in settlement of an overdue account receivable from Concord Sounds. So what this is basically saying is that Concord Sounds had an account receivable which they did not pay us, and so what we're going to do is basically convert the account receivable to a note receivable with these terms. So how are we going to do this? Basically, let's think about what the account receivable has become. It's going to be removed. The account receivable is going to be removed. So we know account receivable is typically a debit normal. So to remove it, we're going to have to credit it by 9,000. And what are we getting in exchange? A different type of asset called a note receivable from Concord Sounds for $9,000. So we're basically swapping one type of asset for another. We are removing the account receivable and we're switching it to a note receivable. So let's see. Okay, great. Okay, so next we have to make an adjusting entry to accrue interest on the Concord Sound note. So we see here that this is going to be an adjusting entry. Basically, we see it's the end of our period, and so we have to basically think about how many days have elapsed from the start of the note until this point in time at the end of the period where we are going to be accruing interest. So we'll also note here that for notes stated in days, use a 360-day year. So in the book, we talked about using a 365-day year and putting 365 days in our denominator when we were calculating interest. But for this question, it looks like they want us to use a 360-day year. So instead of using 365 in our denominator, we'll use 360. So the next question is, how many days has elapsed from December 31st through December 6th? So if you just do a simple subtraction, 31 minus 6 is 25. So since it's in the same month, and again, we do not want to count this day that this note was originated, simply doing the subtraction will give us the correct number. So it's going to be 25 days. So the math is going to be 9,000, which is this, times 12%, times 25 divided by 360. So when you do the math, you're going to get, well, let's first record the revenue. So we're going to have interest revenue. And according to the calculations I'm seeing, it is $75, which again is 9,000 times 12% times 25 divided by 360. So that is our interest revenue. And again, we're accruing this. This is a adjusting entry. So we're not actually receiving cash. So we're going to have a receivable that's created. So we'll have interest receivable here at 75. Okay. So now make a closing entry for interest revenue. So basically, if you remember from how to close out at the end of a period, we're going to have to basically debit interest revenue to close it out. And what account do we use to do that? As our credit, we use income summary. So we have this interest revenue here open at the end of the year. Now it's asking us to make a closing entry. So we're basically going to have interest revenue and income summary 75, 75. And again, note that we're not closing out interest receivable. This is going to be a balance sheet account that's going to carry forward to the next period. But for the next period, we want to basically zero out our interest revenue because 2016 is over, and we want to now start from zero and calculate the interest revenue for 2017, which is why we do this closing entry. So let's see how we did. Okay, great. Okay, so on March 6th of the next year, collected the maturity value of the Concord Sound note. So we're going to prepare a single compound entry, and so let's think about how we're going to do this. So the first thing to do is to calculate the total amount of cash that we're supposed to receive. So if you look back, the principal amount on the note is $9,000, and we're going to have 90 days of interest at a 12% annual rate. So first of all, just as an exercise, let's see if this note was actually paid 90 days later. So is March 6th exactly 90 days after December 6th? Let's think about it. So we just did in our previous example, or rather our previous entry here, we determined that from December 6th through December 31st is 25 days. And so let's do the math from then on. So if I open up my calendar here, January has 31 days, plus February has 28. I'm assuming it's not a leap year. Hopefully it's not. And then we add the 6 days in March from March 1st through 6th here. And yes, that's 65. So if we have that 65 days plus the 25 days from December 6th through 31st, that adds up to 90. So yes, March 6th is 90 days exactly from when this note was originated. So let's use our calculation of 90 divided by 360. That's our fraction of the year. So that's a quarter of a year basically, using a 360-day year, times 0.12, or 12%, times 9,000. So I'm getting $270 of interest. So if we add our interest plus our $9,000 of principal, that means we're going to have a total amount that we collect of $9,270. So this is going to be in the form of cash. So now, how do we do the rest of this? So for one, we are going to definitely remove the note receivable because it's now paid off of $9,000, which we again created right here. This note receivable debit, we are now crediting the same note receivable to clear it out since it's being paid off. So now, how do we deal with this interest? So if you look back here, we recognized $75 of the interest when we made this adjusting entry. So we're not going to duplicate this revenue in the new year because we already took it. So instead, we're going to basically credit out this interest receivable for $75. So we have interest receivable, 75, and so the rest is going to be interest revenue, which we basically earned in this next year, 2017. So you could do the math. It's basically 9,000 times 0.12 times 65 divided by 360, because remember, 25 days happened in 2016 and 65 days happened in 2017. So we're just now recognizing the revenue for 2017. And so yes, that's $195. So I think according to my math, everything checks out. The debits and the sum of the credits are equal. So let's see. Yep. Okay, so next we have an $11,000 loan that we're giving to Main Street Music, receiving a 6-month 12% note. So we're going to have a note receivable and we're going to be lending cash. So this is going to be 11,000. This is going to be 11,000. So I think that's it. Yep. Okay, received a $9,000 60-day 12% note for a sale to Salem Sounds. So for now, we're going to ignore the cost of goods sold. So we are basically going to have a note receivable to Salem Sounds, and it's essentially like a credit sale, except instead of a account receivable, it looks like we're giving them longer days and we're charging them interest, so it's a note receivable instead of 9,000. Okay. Okay, so now 60 days later, it looks like Salem Sound is gonna not do right by our business and not pay the note. So what are we gonna have to do? We're gonna basically have to transfer this note receivable and the accrued interest to an account receivable. So we're gonna have an account receivable for Salem Sounds. We're gonna have this note receivable for Salem Sounds. And we're also going to have some interest that we're going to have to back out, or rather interest that we will first recognize and then back out. So let's fill in the numbers that we know. So this note receivable will definitely be 9,000 from this entry right here. We're backing it out now. And so let's do the interest revenue calculation. So it's going to be this $9,000 times 12% interest rate times 60 days divided by 360, because October 2nd to December 1st, that's 60 days. And so 60 days of interest has been earned, technically, even though it hasn't been paid. But for now, we're going to pretend like we earned it. So 60 divided by 360 times 0.12 times 90, or sorry, times 9,000 equals 180. So then we're basically going to transfer this note receivable and this interest revenue, which we're recognizing, to an account receivable. But don't get scared. This interest revenue, even though it looks like we are recognizing it, we're gonna account for that by writing it off as a bad debt in the next step. So right now we are, yes, recognizing that we have interest revenue, but it won't last because this note has been dishonored, and so we're gonna have to write this off. But in order to do that, we have to use our allowance for accounts receivable. So that's why we're moving all this stuff into accounts receivable first, and then we'll write it off in the next step. So let's see how we did. Okay. So yes, now we're gonna write off this account receivable, which we just created in this previous step, because we were using the allowance method. Okay, so rather, we are using the allowance method, so we're not going to expense it. We are going to use our allowance for bad debt account since we're using the allowance method. So how's that going to work? Basically, we are going to have our allowance for bad debts, which again is not an expense account. This is a contra asset account that is linked to accounts receivable, and it already includes expenses, or rather it has a reserve for bad debts that we are using as a placeholder so that we can adjust for bad debts once in the year to kind of estimate it and to adhere to our matching principle. So we're going to use this allowance for bad debts, and we are basically going to write off this 9180, which we just created. So we have 9180, 9180. Okay. So you may be a little confused. Just to explain, we recognize this revenue here, but we're not really recognizing an expense to offset it. So you may be thinking, hey, isn't that some manipulation? We're adding this revenue here that's not really earned. If your company is doing an honest job of adjusting for this allowance for bad debt, this will eventually be adjusted for when you do that bad debt expense at the end of the year, because this allowance for bad debt is going to have an unadjusted balance, and when you do your calculations to basically figure out how much your allowance for bad debt account should be based on expectations, you will likely have to take an expense in order to get it to that target, since you've been writing stuff off during the year like this. So eventually, when you do the adjustment, it will be accounted for in the bad debt expense that you do at the end of the year. Okay, so finally we have collected the maturity value of the Main Street music note. So again, this is kind of the same kinds of calculations we've been doing. We are going to be collecting cash. We are going to be removing the note receivable from Main Street Music since they're paying it off. And we're also going to be recognizing some interest revenue. So now let's fill in what we know. We know that this is 11,000. That's pretty much the only thing we know right off the bat. Again, that comes from this right here, where we created this note on June 30th. So it's now been 6 months. So our interest revenue, the calculation is 11,000 times 12% times 6 divided by 12, because it's been 6 months. So from June 30th through December 30th, that's 6 months. And there's 12 months in a year. So you take the annual 12% interest and multiply it by 6 over 12 and multiply that by the principal amount of 11,000, and the calculation I'm seeing gives us an interest of $660. And then finally, we're going to collect cash of principal and interest. And so let's see if that works. Okay. Okay, that's it.